A very good day for Dr. Vaye and everyone. Today I'll be presenting my research titled The Effects of Internal and External Factors of Credit Risk on Bank of East Asia from 2014 to 2023. This study examines the credit risk performance of Bank of East Asia or BEA over the past decade. We analyze how both internal financial indicators and external macroeconomic conditions have influenced the bank's credit risk exposure. The goal is to better understand what drives BEA credit risk and how it can be more effectively managed. Credit risk is one of the most critical risks in banking industry. It refers to a potential for a borrower to default on their debt obligation. In BEA's case, the credit risk has been rising due to its high exposure to Chinese commercial real estate sector, which has become increasingly unstable. In 2023, BEA recorded Hong Kong dollar 5.5 billion in impairment losses, leading to a 5.5% drop in net profits to Hong Kong dollar 4.12 billion. These losses reflect not just poor lending performance, but also a need for a better risk assessment and credit risk monitoring system. Hence, this study aims to identify the key drivers of credit risk by BEA, with focusing on internal financial ratios and external economic conditions. The main problem this study addresses is the persistent and growing credit risk BEA faces due to risky loan exposure and changing economic conditions. The research has three main objectives. First, to investigate the influence of internal firm-specific factors such as return on asset, capital adequacy ratio, and risk-weighted asset. Second, to examine how external macroeconomic indicators like GDP growth, inflation, and employment affect credit risk. Third, to assess whether a combined model using both internal and external variables provides a more accurate and complete understanding of the credit risk landscape at BEA. Based on this objective, our study was guided by three key research questions. First, is there a significant relationship between internal factors and BEA credit risk? Second, do external macroeconomic factors also have significant effects? And third, does combining both internal and external variables provide a stronger predictive model? Corresponding to these questions, we formulated three hypotheses. First, internal factors significantly affect BEA credit risk. Second, external factors significantly affect BEA credit risk. And third, the combination of both internal and external factors result in a better explanation of credit risk than either group alone. Our variable selection was informed by previous studies. Credit risk is typically measured using expected loss model, EL equals to probability of default times loss given default and times exposure at default. Accordingly to Suhartono in 2023, RA tends to decline as non-performing loan increases. CAR, according to Wan Johi, is a buffer that allows banks to absorb losses and continue lending. RWA discussed by CITRS reflects the riskiness of a bank asset, and high RWA indicates more exposure to risky lending. External factors also play a role. Castro found that GDP growth, lower default risk, high inflation, as noted by Sharma in 2024, reduces consumers' purchasing power and increased loan defaults. Exchange volatility, especially when borrowers have foreign currency loan, increases credit risk. Unemployment, as Bai points out, leads to higher defaults, especially in personal loan. This study uses quantitative research method and data from BEA's annual report and various economic database from 2014 to 2023. We use SPSS version 26 for data analysis, applying the ordinary least square known as OLS method in multiple linear regression. We built three models. Model 1 uses only internal variables such as ROA, CAR, RWA, debt asset ratio, loan loss provision, and equity multiplier. Model 2 includes external factors like GDP, inflation, interest rate, exchange rate, unemployment rate, and yield curve. Model 3 combines all internal and external variables to test their joint impact on BEA's credit risk. Our correlation analysis revealed several important relationships. RWA and CAR both show a strong and statistically significant correlation with credit risk. The exchange rate also showed significance, while the interest rate did not, with a p-value of 0.357. Looking at the model fit, all three models were statistically significant, but Model 1, based on internal factors, had a higher explanatory power, with an adjusted R-square of 0.947. Model 2 adjusted R-square was 0.863, and Model 3 was 0.933. In Model 1, CAR was the only variable with statistically significant impact. In Model 2, GDP, inflation, exchange rate, and employment, and the yield curve all significantly influence credit risk. Interestingly, in Model 3, RWA emerged as the only consistently significant predictor across all three models. In summary, the finding shows the internal financial factors have a stronger and more consistent influence on BEA credit risk than external factors. Specifically, risk-weighted asset and capital adequacy ratio are key indicators, while external variables like GDP and inflation do have some impact, especially during economic shocks. They are less reliable predictors over the long term. The combined model did show strong results, but internal metrics remain the most dependable for forecasting and managing credit risk in BEA. Based on our findings, we have 5 main recommendations for BEA. First, strengthen its capital adequacy by increasing the capital adequacy ratio to improve its capacity to absorb unexpected losses. Second, manage RWA more effectively by reviewing and optimizing the bank asset portfolio to minimize exposure to high-risk assets. Third, diversify the loan portfolio by reducing reliance on Chinese commercial real estate and expanding lending to lower-risk industry and regions. Fourth, implement regular stress testing and scenario analysis to anticipate the effects of macroeconomic shocks. Fifth, improve early warnings and credit monitoring system so that emerging risks can be detected and addressed before they escalate into larger problems. That concludes my presentation. In closing, this research emphasized that while external economic conditions do matter, it is the internal financial strength and risk management strategies of a bank that primarily drive credit risk performance. For BEA, improving capital adequacy and closely managing its risk-weighted assets are critical steps to safeguard its financial health. That's all from me from today, and thank you for your attention.